Welcome to this webinar in which we're going to look at the government's coronavirus business interruption loan scheme. My name is John Boydell and I'm a director of Ampios Management Partners. I'm formerly a corporate lawyer, but for some years now with colleagues, we've been helping businesses, entrepreneurs with strategy and implementation of strategy to build businesses. I'm here today with my colleague Stuart Fell, and we'll be taking you through the main provisions of this scheme, whether it's right for your business, how to go about accessing it in practice, and crucially, what the banks will look at supporting and what they won't. So let me first introduce Stuart, who'll tell you a little bit about his background.
Hi, John. Thank you. My name's Stuart Fell, and until recently, I had spent over 40 years in corporate banking. 30 of those years was a frontline relationship manager, and the last 5 years was actually in credit itself as a senior credit manager. So hopefully I can give an insight as to how credit teams will think and look at any proposition.
Thanks very much, Stuart. First of all, it's just necessary to say that we can't in a webinar reflect the particular circumstances for each and every business. So this is just general guidance and overview, but we do hope you'll find it. We hope you'll find it useful. Normally, for a webinar, we'd be in our studio producing it, but obviously, given the current coronavirus difficulties, we're having to follow the advice and work from home. So please bear with us on that. Okay, so let's have a look at the headlines before we go into the secrets of how to prepare properly for an application. This facility can be up to £5 million. It's 80% guaranteed by the government in the event that the borrower can't repay, but remember that's a guarantee to the bank. That's not a guarantee to the borrower, who will still remain 100% liable for it. Often a business would have to pay a fee to have a guarantor, but for SMEs with this scheme, there's no fee, which is useful. The government, it's also useful that the government pays the interest and other fees for the first 12 months. If it's a term loan or asset finance, facilities can be up to a useful 6 years. For overdrafts and invoice finance, they can be over a period of 3 years. If the facility is for less than £250,000, then it can, at the discretion of the lender, be unsecured by the borrower. Above that figure, the lender has to check that there's no other security available. It is, as I mentioned, also important to remember that the borrower does remain 100% liable at all times, and the guarantee only comes into play if the lender can't recover the money from the borrower after going through all its normal recovery procedures. So it's not, it's not free in that sense. The liability is still there with it. It is an ultimate safety net to the banks, not to the borrower. So it's mostly good news, at least on the face of it. Are you interested? Okay, let's have a look now at eligibility. Firstly, the application for a facility has to be for business purposes. I mean, that sounds obvious, but for the minority who might want to access funds for other purposes, sorry, you'll be disappointed, because that will be looked into, and you won't have any luck if you think you can access money for something else. Next, you have to be UK based with a turnover of less than 45 million. If that's not you, then I'm sorry, the scheme's not for you. In addition, if you receive funds, they have to be used primarily for activities in the UK. Another one of the criteria, that more than 50% of your turnover has to be from trading activities. Important to remember, and again, that will be looked into. There are some excluded businesses, notably insurers, but not insurance brokers. So insurance brokers do qualify and could potentially make application for funding. Public sector organisations can't apply, and that includes state-funded schools. And then you have employer and professional membership organisations who also can't apply. So here's a summary of eligibility. Okay, so let's move on to a trickier part of persuading your bank, or if they won't back you, another bank to advance you the money. This is where you need to apply insight into what banks do and what they don't do. Banks have a particular marketplace. They are not risk lenders. That's the territory of private equity and venture capital, and that's not what banks do. They lend against the ability to repay, to service the debt and to repay it. So they look at security and they'll look at profits and cash availability to service the debt. That's their marketplace, and it's important to understand that. Stuart, of course, is ideally placed to comment, given his banking background, and he's going to take you through the next section of this webinar. Thanks, Stuart.
Thanks, John. As we've said, we'll try to give you an insight as how credit departments and how lenders will assess any proposition that comes across their desk. Let's state the obvious. Lenders are there to make money. They make money from lending and making a return on the monies lent. They spend an enormous amount of time in assessing the risk-reward balance. Can they make a return for the perceived risks they assess in a lending proposition? If they can make a return, then they will lend money. If the perceived risk is too high and they don't see a sufficient return, then that will result in a decline. They're there to make money. The lending criteria of the banks and the lenders has not changed. It hasn't changed in the 40 years I was in the industry. And I was speaking to a colleague of mine only the other day just to see whether things had changed in the current circumstances, and they've not. The lending criteria the lenders will apply remain the same. What has changed is the amount of scrutiny they will bring to bear in looking at any proposition. So the fundamentals are the same, but the scrutiny has and will increase. So the trick is to anticipate that scrutiny and answer the queries they are likely to ask themselves in a rounded business plan. And indeed, the coronavirus business interruption loan scheme specifically mentions that normal criteria will apply. The attraction to a lender of an 80% government guarantee is obvious. But there are some downsides to it, and we will cover that shortly. But the lender will not simply look at a security without viability. So here's a slide of what the lenders and the banks will look at this scheme and look at it from their perspective. The banks will have to pay a fee to join this scheme. You as a customer applying on this scheme will be no fees. There's no fee to join, but the banks will have to pay a fee, and that will reduce their profits. They'll be looking for a return on that investment. There's a cap on per lender. The government will give each lender a cap of how much they can actually claim under this guarantee. In the early days, in the early weeks, and the early months, that won't be an issue. But the lenders will be looking for the better type propositions, because if all the propositions fail in the early weeks and months and they claim the 80% on the guarantee, they will hit their caps pretty quickly. So that's a consideration that they will bear in mind. They will not want to hit that cap, certainly in the short to medium term. And whilst the 80% guarantee is attractive, there still is the real prospect that they will lose or incur a loss of 20%. And banks and lenders do not like to lose money. The British Business Bank has got a particularly good website with lots of information, a lot of Q&A, question and answers there, and I'd recommend you go and have a look at that. But it says there that the normal lending criteria will apply. If there is security that you can secure lending on normal terms outside the scheme, then the lenders will look to structure the lendings on that basis. These kind of guarantee schemes are very useful where there is a lack of tangible security, which would prevent the bank lending to a viable proposition. The phrase viable proposition comes up repeatedly when you start looking into these schemes. So what is a viable proposition in context of this guarantee scheme? Well, in simple terms, it boils down to if there's a viable business that otherwise would have been all right but for the coronavirus, and it will be viable again once this virus has passed, and it can meet serviceability criteria, then the scheme potentially comes into play for that business. But there's a lot of ands and buts within that context. I think it's fair to say if you weren't a viable business before this virus, then it's highly likely you won't be viable going forward. This is not for a turnaround situation. If you're viable now, you're going to be viable in the future. This is where the scheme can play an important part. So let's just look at what the lenders look at when considering the viability question. You may have a relationship manager, or you may deal with your bank via telephone banking or centralized online teams. But the process will be roughly the same, whichever avenue you go down. Your relationship manager, highly unlikely he or she will have the ability to sanction a facility under this scheme. It will almost certainly, in my experience, go to a credit team. And that's because there's a perceived increase in risk in looking at these kind of schemes. So that's why the credit teams will control which get sanctioned, which propositions get sanctioned and which don't. Here's a slide that credit teams will almost certainly go through. There are others, but these are probably some of the key things. They'll ask themselves, what's the trading history of your business? Is it a good trading history? Have you got 2 or 3 years? Have you got more track record? They will be looking for trends in that historic information. Have you got any current MI, management information? The history is very good at telling you what you've done, but what you're currently doing. And I strongly suspect what your current trading this week, last month, and the last quarter would be significantly different to what you were doing this time last year. So having an understanding of where you are now will be important. And if you haven't got that information, I suggest if I was looking at this proposition, any proposition, I'd be looking for that information. I think without it, things would get stalled or just declined. I think it's so crucial you have that up-to-date information. What's your credit history like? When I'm looking at a proposition, what have you borrowed in the past? How have you repaid it? Not only with us, but with other lenders. Have you got some HP? Have you got other facilities? What's your credit history like? And tell them what your credit history is like. If it's been good, tell them a good story. If there's been problems in the past, tell them what the problems were and how you've overcome them. Because that can be just as important as evidence that you're used to dealing with problems. A good business model will have strong management. Tell the lender what the management team's about. Do you have the agility? Do you have the controls? Do you have the resilience or experience of dealing with the situations we're in? Share that information, good and bad. The assessment of the management is one of the key criteria I, as a credit manager, would look at. It's not on the balance sheet though, so you tell them that information, share that information. What's your future cash and profit profile looking like? Your assumptions that you use in your financial projections should be credible and be supported by evidence. Do they stand up to scrutiny? Your credit team will ask themselves, and probably you, why you think you're going to increase something by X or Y or Z. Provide that information in the business plan. Give some good, detailed narrative behind the assumptions. Don't let them guess. If there's a void, they will try and second guess, and they may get it wrong. Give them the narrative behind the assumptions. You need to demonstrate to the lender, or to me if I was a credit manager, that you're solvent. You've been solvent in the past. Things might be slightly different now in the current situation, but can you return to solvency in the short to medium term? Banks and funders do not like funding failures waiting to happen. I think the next bit we'll do a bit of question and answers of some of the issues and a bit more of the flesh on the bones of how I, as a credit manager, would look at a proposition.
Yeah, I think it's a good idea, Stuart. So for the purposes of this this exercise, I'm the borrower. You're the guy in credit, and I'm trying to impress you and get you to advance me the money. How important is your perception of a steady stream of cash coming in?
It's an old adage, cash is king. Was as valid 40 years ago when I first joined the industry, and it's as valid today. Cash is the vehicle that you will repay your loan and your loans and pays your bills. So I'd be looking at, do you have a steady stream of cash coming in? How do you look after your debtors? Do you chase your debtors? What credit terms do you give them? Who are they? Are you overexposed to any particular debtor failing? Is the cash flow lumpy? Or is it nice and smooth each week, each month, or each quarter? Big lumpy amounts owed to a few debtors generally is not attractive to lenders. Invoice discounters can take a view, and some of them will take a view on specific debtors, but the mainstream lenders on the high street generally don't like big lumpy debtors and cash flow. So
I need to tidy up my my debtor book before I come and put my proposition to you. Then just try and get as much in as possible. Just have that looking tidy.
Absolutely.
Yeah. Okay. What about security, Stuart? What's the view, particularly in this scheme and the attitude of the government security? From a credit point of view, how does that feature in the equation?
Well, the good news is the attraction of an 80% guarantee by the government is attractive. But it's only attractive if there's an underlying viable business that demonstrates its ability to repay the loan. But having that backup of that 80% can be useful. We're picking up anecdotal evidence that the top 4 banks, the major banks, will not look for personal guarantees for facilities up to 250,000. But beyond 250,000, I would say expect a discussion regarding security. The British Business Bank guidelines suggests that the bank must establish that the borrower is unable to provide security before it uses this scheme. The good news is that your primary residential property cannot be used as security, but the banks will be having a detailed scrutiny to see whether you or the business has got security that it could pledge under its normal lending criteria.
As a borrower, Stuart, should I be looking to volunteer security, which seems kind of counterintuitive? I wouldn't really want to give it away if I can avoid it. Are there circumstances where actually I should just grasp the nettle and volunteer security?
That's a good question. In my experience, the good management teams offer the availability of security in a structured way. They're being proactive. They probably know the questions, so the question is going to come down the line and the debate's going to be had. So proactively putting that into the debate early, I think, is a sign of good management. If you've got some security that you could stack up normal lending criteria, the banks will do that. I would do that as a credit manager. I would look at these kind of schemes that underpins viable propositions where there's a lack of tangible security, and almost as a lender of last resort or provider of security of last resort, you could look at these schemes for the 80% guarantee by the government. But just if you're applying for one of this scheme, at least be aware you may have a debate of security. But the good news is they can't take the house as primary security under this facility. Right.
You were talking earlier about the management team. How important is that perception of the who versus the what? How from a, if you're sat in credit, where's that equation lie?
It's probably alongside cash, probably the most important thing I would consider. Both as a relationship when I was a relationship manager and when I was a senior credit sanctioner. As I said before, it's the one thing that's not on the balance sheet. It's the one thing that I can't go and search. I can't find any third-party evidence of it, or it's very difficult, but it's probably the most important part of any lending proposition. There are good managers, there are good management teams that will prosper in recessionary times. There are poor management teams that will fail in prosperous times. Good management teams operate in difficult sectors and prosper. There are poor managers that operate in buoyant sectors that ultimately fail.
Interesting. What about the debt to income ratio? I mean, lots of people have heard the expression. Again, from a credit point of view, can you just sort of explain to our viewers about debt to income ratio and its importance in the credit decision?
Yeah. So as a credit manager, once I've got comfortable with the management team and the track record and what they're looking to do, the viability often sits around your ability to repay interest and your ability to pay capital and interest. And one of the first couple of calculations I would always do is an total interest bill to EBITDA, earnings before interest, tax, depreciation. How much do you have to be able to cover the interest bill? And not just the interest bill on this particular loan or this scheme, but across all your borrowings, HP, loans, overdrafts, everything. What's the total interest? And what's the relationship that to EBITDA? Every lender has a different criteria, but it could be typically they'll be looking for somewhere between 150 and 250% cover. The other crucial debt to income ratio is what we call debt service cover. What's the total amount of the capital and interest you have to pay in relation to EBITDA? As an absolute minimum, you would want it to be, or I would want it to be 110%. The bigger that number is, the more comfort the lender has that something could go wrong and you could still have the ability to service your facilities. So the interest to EBITDA and your total debt service are two crucial calculations. And clearly your existing debt plus the new one play an important part. So if you're heavily borrowed, heavily geared already, and you're adding further debt, and remember, you will be 100% liable for this. The guarantee only is applicable to the lender at the final, in the final analysis, should the business fail. But you're 100% liable for this. So it's how strong is your income stream, how strong is your cash flow to be able to service the interest and the debt, sorry, and the capital and interest. Two crucial calculations that you should be making to at least give you an insight as to what the bank is going to be looking at. And can you do anything to improve it?
Right, okay. What about the sort of customer makeup? I mean, I presume you're happy if I've got lots and lots of customers, I've spread my risk. Well, what if I've only got a few? There might be good ones, but what if I've only got a few? How's that perceived from credit?
One of the reasons why, as a credit manager, I would look to get a copy of the debtor and creditor list is to see what the concentration is like. Are you reliant on a couple of key people, customers? There's nothing wrong in having high concentration of your sales into a few customers. The key thing is, who are they? What information do you have about them? If you're going down the invoice discounting route, are they insurable? What happens to that customer if they go bust? And what impact does that make on your business? I'm looking for that kind of profile. Ideally, the bigger the spread reduces the risk, but doesn't eliminate it. if there's a perceived higher risk in having a few crucial customers, I would need more information to be comfortable that that's not a high risk factor. So what could you give me that would mitigate that perceived high risk?
Right, right, okay. Moving on to different sectors and the state of the economy. How is that factored into the lending analysis and the lending decision?
Well, each sector will suffer differently. There's no doubt about it. The economy is going to struggle, is struggling now, and is likely to struggle certainly for the short term and maybe medium term. But how people react and how they suffer will be different. For instance, if you're in the food industry, I suspect at the moment your cash flows and P&Ls are probably holding up reasonably well. If you're in the holiday sector, your P&L and cash flows are probably just falling off a cliff. But how are you managing that? Whichever sector you're in, how are you managing that? As a credit manager, I would have an overview of the sector as a general overview, but I won't know the specific of where you fit in that sector. There are good businesses, I've said before, there are good businesses that under good management will prosper out during the current position and as we come out of it. And they will be in sectors that are perceived to be struggling and having problems. So I would have a view of the general sector because I'll have information from the bank's resources. We'll get loads of information from third parties. That's reasonably easy to get to. I mean, you could Google that yourself and you get an overview pretty quickly. But what I'm really interested in is where you sit in that sector. How are you going to survive and prosper in your sector from your perspective? I can then judge that against what I'm seeing elsewhere because I will see lots of propositions within the sector and I'll see the good, bad and the different. So I can benchmark that, but tell me where you are in the sector.
Right, okay. I mean, I think most people have heard, certainly in investment terms, that the past doesn't guarantee the future. Does the past matter from the past sort of track record? Does that, if you see a good steady past track record, does that actually, even though it doesn't guarantee the future, does that give comfort about the future from a lending proposition point of view?
Very much so. Very, 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 very much so. If you've got experience and a track record of dealing with difficulties, there's a high probability that you will have the skill set and you will have the resilience to deal with the current situation and going forward. There will be a number of businesses that have been through 3 or 4 recessions. They will have learned how to be resilient in a recession, and knowing that and having an insight to the management's ability to deal with that is important. If you're if you've been in business for the last 10 years, since what, 2008, if you've been in business since the last 10 years, you probably not experienced a deep recession. And there are lenders, there are bankers out there who may not have been through it. Certainly in 2008, it was 15 to 20 years before the previous recession. And there was lots of people, customers and bankers and lenders, who had known nothing but a good, buoyant market. So having a track record in that scenario is invaluable. If you've got it, share it.
Interesting. And what about, I mean, again, sort of one of the things you hear is that finance, money, it's all about confidence. What about the consistency of information that you give? How important is that one piece of information logically follows another and so on?
Yeah, I can't underestimate how you communicate will be absolutely crucial. It should be hopefully be professional, thorough, in a cool, calm and balanced way. And you'd be surprised how many business plans that I have seen in my career that something is said on page 2 which contradicts what something said on page 20. The words and figures have got to match, because if it doesn't, you lose credibility. And once you start losing credibility, the lender will lose confidence in what they are seeing and what they are reading. So it is absolutely important that you have a consistent message going all the way through. And if you've got the ability, have your business plan reviewed by somebody who's not been actively involved in it. That almost critical analysis by somebody who's seeing it for the first time. Because the credit manager is probably seeing this for the first time.
Right. Well, I mean, it kind of leads us nicely into, preparing your funding application, presumably supported by a business plan. Perhaps again, from your perspective, this thing's about to land on your desk. What should be in a good business plan to get you to be interested in it?
Okay, and it might sound very daunting. You might be writing a long list of things, or they want this, they want that. I suspect you're doing quite a lot of this already. And certainly the credit managers are doing this day and out. This is bread and butter to what I was doing as a credit manager. It's almost 24/7. So just having an insight, if as a customer, if you can have an insight to what your credit team are thinking and doing, is helping you increase your prospects of getting some support. So it's not as daunting as you think. There's lots of people to help you to do that. And I'm always conscious of the adage, if you don't ask, you don't get. But if you ask badly, you also don't get. Mm. So what would I be looking at in a business plan? Well, I think it needs to do 2 things. It needs to tell me a story of where you or your business is going and why it needs the money. And it provides evidence to back up that story. And the history, the back history, the track record play an important part in that. And going forward, the projections, the assumptions behind all the projections. But when I pick up a business plan, I usually get a pretty good idea of the quality in the first couple of pages. If you've got a compelling opening 1 or 2 pages that are an executive summary, it tells me within the first 2 pages broadly what it's about, why you need the money and how you're going to repay, you've got my interest. If all the good news, if all that good news is on page 20, you've probably lost me. We're all human, it's human nature. Can I get a quick snapshot in the first 5-10 minutes? That executive summary is so important. You'll put the rest of the business plan around it, the supporting documents and the supporting evidence. And you can put your CVs, management CVs, and your profit projections, your cash flow in the appendices. But you can put the summaries in the bulk of the report, and you've got an executive summary up front. The amount of business plans that don't have executive summaries is quite high. It never fails to amaze me. So a good executive summary. So and expand the story beyond that. Trying to avoid repetition. The amount of times you will see the same things being said on page 5, 15, 30. It's just an irritation, and it's not a good reflection on the management if it's just repeating the same story. So make it relevant, make it punchy. I always like to see the management team's CV. Not every business plan has it, but that gives credibility to me. It gives me an insight to what you as a management team can bring to the table. Without that, I'm guessing, or I've got to go back and ask. If I've got to go back and ask a load of questions, it's going to delay things. In the last recession, the predecessor to this scheme was called Enterprise Finance Guarantee, EFG. Typical turnaround, 8 to 12 weeks. Anecdotal evidence so far, and it's early for this, but don't be surprised if it takes anywhere between 4 and 12 weeks. So if I've got to come back and ask the questions, it's going to delay things. So put your management CVs, put your accounts, historics, your management accounts, debtor and creditor lists are always useful. Put them in the back. I mentioned before the assumptions. I can tell you what not to do. Don't send 3-page cash flow, P&L spreadsheets with 2 lines about assumptions. Because if you do, it doesn't reflect well on you, doesn't create a good impression. And secondly, I'm going to second guess what I think you're trying to tell me. So a good detailed narrative around the assumptions, back it up by evidence, because I'll be asking myself, well, why? What proof is there? Why should you increase your sales by X, Y, and Z? Why can you get that sale? Why can you get that cash flow? So preempt those questions. A good narrative is absolutely crucial. Without it, I'm going to be second guessing. Don't let people second guess. Tell them the story. And even tell the bad news, but then how you're going to mitigate the bad news is a positive.
So at the end of the day, it boils down to apply early, prepare well, and tell a compelling story and back it up with evidence. But in a nutshell, that's where you've got to be, haven't you? And as you were saying to us there, don't leave lots of questions unanswered, because A, it doesn't look good, and B, it just creates delay.
Absolutely. Absolutely.
Fantastic. Thanks very much, Stuart. Well, everybody, hopefully this webinar has given you some additional insight into the coronavirus business interruption loan scheme, and whether it's appropriate for you, and in particular what to expect from lenders. Hopefully you've found Stuart's insight of looking through it from credit's eyes useful. You see various bits of information published, but it is quite useful to have that experience tell you, what the decision makers look for, what does impress them and what doesn't impress them. If I can say again, do remember this is only an overview. It's not advice to your particular business and its particular circumstances. There are likely to be some follow-on details in relation to this scheme, and also some matters of interpretation. So you need to keep watching the space for any further information that's coming out. So we do thank you for watching. Hope you found it useful. If you do need some particular advice and guidance with this scheme or funding generally, vetting of an existing plan before it's submitted, or help with preparation of a funding application and plan, then you can contact us, and of course we'll be happy to help you. And thank you very much for watching from Stuart and from me. And I'm sure Stuart, you wish everybody well.
Yes. Good luck with your propositions. There's lots of advice out there, but do it professionally and do it quickly. The credit teams right across all lenders are going to get inundated. Good luck.
Thanks very much, everybody. We hope you found this very useful, and we've enjoyed presenting it to you. Thanks again.